So buy now, pay later is a really controversial business model at the moment, but that hasn't stopped it from becoming really damn popular as well. Now, with a quick Google, you'll find all kinds of different articles calling the practice predatory, claiming that it's just the modern day version of usury. There are loads of people with lots of bad things to say about buy now, pay later, and there's a load of bad press about it as well. It's pretty safe to say that it's one of the most unpopular business practices around today. That didn't, though, stop it from absolutely exploding over recent years. Over the last decade or so, it's gone from something that really didn't exist at all to something that dominates the checkout page of almost every website in the West. It does now seem that that bubble has finally burst, though. Klarna, the king of buy now, pay later, saw its valuation drop from $46 billion just 1 year ago to $6.7 billion just last week. They managed to raise $640 million for just over 1% of the business 1 year ago, and then as of last week, to raise $800 million, they had to give up almost 14%. The value of this company is down by almost 90%, but unfortunately for Klarna and for the rest of the buy now, pay later market, the trouble isn't going to end there. Today, we're going to discuss Klarna in particular, why it's getting hit so hard, before looking at buy now, pay later on a broader scale, looking at the industry and that market as a whole, and establishing just why it's doing so poorly over recent weeks. So first of all, what actually is Klarna? Well, it's just a different way of paying for something online. You put something in your basket with a company like Nike, you go to checkout and there'll be a button with a pink logo that says Klarna on it, and you click on there and you can pay in 4 easy monthly installments, totally interest-free. It's basically just spreading out the cost of a purchase over multiple months, which has always existed to some degree, but it's absolutely exploded in popularity over recent years. In short, it's credit. It's debt. It allows people to spend more money with the income or the money that they have in their bank account now. Now, the controversy surrounding this whole practice is basically that some people find themselves in too much debt because they think it's too easy to use a service like this. They find it too easy to spend their money. They feel like the money isn't really being spent if they're only paying 25% of it now. And so in the end, it adds up and it ends up sending them into huge amounts of debt. Companies like Klarna are often accused of preying on these people, preying on their inability to make good decisions and their lack of personal responsibility in particular. But from the point of view of a company like Klarna, it's an interest-free loan, right? How could that possibly be usury? How could that possibly be immoral? Because it doesn't actually cost the customer any more money. In fact, with inflation being close to 10% in many countries these days, spreading the cost out over multiple months actually makes the price, in theory, cheaper for the customer. So why does Klarna exist and how does it actually generate its money? Well, basically they charge the retailer for this service as opposed to the customer themselves. Now, why would retailers offer this service if it costs them more money? Well, they've noticed that it allows them to sell more products because people have access to this cheap debt, to this credit. And so this is just another way of debt stimulating spending and helping businesses thrive in that way. Now, Klarna is actually quite a special company, even though I'm going to be talking a lot of smack about it today. And the reason for that is really just from where it came from. Now, the tech market in particular is absolutely dominated by the United States. That's no question, and it's not going to surprise you to hear that either. Klarna, though, is a Swedish company founded in 2005 that has built its way up to become the king of this industry, beating out many other American rivals who have the benefits of being based in places like San Francisco, where access to venture capital money is incredibly easy and cheap. It's actually really quite rare for a European tech company to start on equal footing with American companies and to still win out. And over the last decade or so, there are only 5 to 10 of these companies that have actually made that happen. And Klarna certainly have made it happen. They are the biggest player in the buy now, pay later space, and they are still growing at a pretty damn incredible rate, and they're projected to remain the #1 player in this space too. Now, back in 2021, back when the money printer was churning and people were adamant that inflation would never be an issue because modern monetary theory is the new craze, Klarna wanted more money to help expand their business, and so they went to private funding, and they managed to raise money at a $46 billion valuation, which at the time made the owner and founder of this company the richest man in Sweden. Now, this funding round was unsurprisingly led by SoftBank's Vision Fund and Masayoshi Son, a man who has become a little bit infamous these days for being a bit like Cathie Wood, only in the private markets, for throwing money at companies that really have no basis being valued as expensively as they are. There have been a lot of people making the claim that maybe this whole fund in the first place was a bit of a fluke. Masayoshi-san bet big on Alibaba and it paid off handsomely, but he struggled to replicate those successes in more recent years. What SoftBank's Vision Fund does encapsulate very well is the crazy bull run that started as the COVID pandemic took hold and as lockdowns encapsulated the world. Companies like Peloton that had no business being valued in the tens of billions saw their share prices run up ridiculous amounts. And it was all based on the idea that money was being printed, capital was incredibly cheap, and so it was incredibly easy to grow a business at that time. This isn't 2020 anymore, it's not even 2021 now, it's 2022, and that whole house of cards has fallen apart. Klarna is obviously still trying to finance its expansion. It isn't done growing, and so earlier on in the year, it went round looking at private investors trying to gauge what kind of valuation they'd be willing to buy into the company at, and they thought that $25 billion was an appropriate value, an almost 50% discount from where SoftBank's Vision Fund invested just a year prior, but they couldn't find a single buyer. So they kept dropping their price until they got to the valuation of $6.7 billion, about an 85% hit from their previous valuation, where they were able to secure about $800 million to finance their expansion in exchange for a very hefty portion of the company. Now, this being a fintech or a tech company in 2022, it wouldn't be fitting if the company was still hiring staff. No, they're doing the opposite as well. They've already fired 700 of their employees over this year alone. That's 10% of their workforce, and they're expected to continue to downsize into the future. In short, that is why we're actually talking about Klarna today, because it's the biggest player in this space, and this space is getting absolutely hammered. So what is actually going wrong? Well, the first problem is that frankly, Klarna was just overvalued, just like Peloton was overvalued, just like Coinbase was overvalued, and just like Tesla was overvalued. Its technology really wasn't that groundbreaking at all. It was pretty much just a button that you can put on the end of your checkout, and it allows customers to spend a little bit more money into the long term. It really wasn't something that was actually groundbreaking, and it didn't have any justification being valued at $46 billion. Just like a few other industries with this same sort of downfall, like DocuSign, Signable, and other e-signature companies, there was no moat between any of these companies. There was no differentiation between them either. They were all virtually identical pieces of software targeting the exact same audiences and relying on incredibly cheap capital to finance ridiculous levels of growth that would never last forever. Now, the best way for me to show you how this applies to Klarna and the buy now, pay later industry is to show you just a random purchase that I made about a week ago of some protein from a company called MyProtein. No, they aren't an affiliate, but I'll use them anyway. Now, when you go to checkout, as I am showing you here, you have a bunch of different buttons from a bunch of different companies. Klarna, PayPal, Google Pay, ClearPay, Laybuy, Splitit, PayPal again for some reason, Zipmode, Hum, Trustly, and Vine. Now, the vast majority of these buttons provide identical services to Klarna. They're simply branded in a different way. The only reason that someone would use Klarna as opposed to ClearPay as opposed to Laybuy is because maybe they saw Klarna first, maybe it's a brighter logo, or maybe they already have an account with them. Outside of that, there is absolutely nothing stopping a customer from leaving Klarna for a competitor should the product or the service be cheaper or easier to use. This is, by definition, a company without a moat. There is nothing stopping customers from jumping ship. And to make matters even worse, the big boys like PayPal, like Google, and like Apple are all getting involved in this space as well. And that's where problems are really going to start to arise for companies like Klarna. The simple fact is that if you buy an iPhone and it comes downloaded already with Apple Pay and their version of Buy Now Pay Later, that's the platform you're most likely to use. The same can be said for a company like Google, who might be able to embed it into a search engine that you use like Google Chrome. Klarna is no longer the disruptor, they're now a legacy company being targeted by the disruptors, and problems will emerge because of this simple truth. The ridiculous valuations that these sort of companies were receiving in private markets and in public markets as well with a company like Affirm were simply not sustainable because consolidation in this market was always going to come, and as a result, revenues and profits would drop massively as well. Investors for years just ignored this simple truth because there was too much cheap capital around and they had to throw it behind something, so why not put it into a company like Klarna, which is proving to grow very quickly at this point. Why not take that risk when the alternative is to have cash sitting around getting eaten away by inflation? Those times, though, are over. Inflation is so ridiculously high that the Federal Reserve tightening and other central banks doing the same is absolutely imperative. A recession is around the corner as well, and so this world of cheap capital and 0% interest rates is over, and businesses and the business environment will change as a result of that. Unfortunately, though, for Klarna and the rest of this market, that isn't the end of the problem. The second problem comes with controversy and the regulatory risk that comes about because of that controversy. Now, this page here is from the UK and it's not even a month old, but it's basically the British government saying that regulation is coming to this market because they aren't happy with the way that people are being treated, with how easy it is for people to find themselves in debt, and they want to make a change regarding that. The best example of how decimated an industry can become because of this is to look at something like Wonga or the payday loan crisis that we had in the UK over the last decade, where lots of brand new, interesting, innovative tech companies came out and provided payday loans to people for exorbitant charges using special ways to get around interest rate APR rules. And those companies made loads and loads of money for a long time until the government cracked down on it, made that practice illegal, and forced all of those people who found themselves in debt to be reimbursed by the company that profited off of their stupidity. The simple truth is that people are angry about buy now, pay later. Personally, I don't see the problem. I see it as similar to something like a credit card. I believe in personal responsibility, but what I think here doesn't matter because public outrage is there, and so governments will act to curb that outrage. When regulation comes, and it will come in force, companies like Klarna will seriously struggle to maintain the business practices that they're running, and they will see impacts to their bottom lines because of that. Now, the truth is that there are loads of other industries just like this. I've touched on a couple of them in this video and in the past as well. E-signatures is a perfect example of one of these markets that is based on cheap growth forever, financed by cheap capital that they insisted would never disappear. It was this silly idea that this time it's different, that this time it's a paradigm shift, and that we'd never go back to the times before the pandemic, but those people were of course wrong. I would like to just implore you to be very careful when it comes to these sort of investments, when it comes to companies that are promising to change the world. Think actively about how they're going to change the world and what the problems they might run into are. This stock here is from Affirm, another buy now, pay later company, which operates out of the US and is actually public. And it was very popular on the YouTube space over the last year or so, back in 2021. But so far, year to date, it's down 77%. And from its all-time highs, it's down about 85% because this market is just getting absolutely hammered. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.